Welcome to the Broken Pie Chart Podcast, episode 278. I'm your host, Derek Moore. This week, got a lot to talk about. I have a couple listener questions. One of them was on the volatility gap, sort of explaining what that is. It ties in nicely to the idea that you should be hedged, or a lot of people should be hedged to mitigate the downside and mitigate some of the volatility. Also, a couple interesting things in the markets this week. And we'll kind of be, I don't know. I always say, should we scare people? Should we not scare people? Let's kind of have a mix. One of the things I've been seeing lately, and we've said it, is volatility has been low. Not only implied volatility, but realized volatility. And Goldman Sachs, let me see, this Goldman Global Banking and Markets. This is as of June 17th. I know we are recording this on actually a Saturday, the 22nd. But when we look at this, it has number of S&P trading sessions since a 2.05% or more decline, meaning a one-day sell-off. And as of June 17th, and it's actually longer now, it's the highest number of consecutive days without a one-day sell-off greater than 2.85 or 2.05%, meaning it hasn't gone down more than 2.05% on a single day since, 2018 or so. Something like 300 and almost 400 sessions, 400 days. And this is 376. We're probably another week or so. So we're kind of like 385 or something like that. And when you look at, you can't see this chart, but a lot of times what you see is, you see some peaks and valleys in here, 125 days between these. You'll see sometimes 175. But this is a really long period without any material, and I guess, according to this chart, greater than 2.05%. And we've been saying that. Volatility has been muted. I know Jay has said in some of our gentlemen's wagers, he could see a 10 handle on the VIX index. I took the other side, of course, as we normally do, because we're just sort of having a little fun with it. But if I look and see, right now, earnings estimates, and I'll talk about earnings estimates and how they'll be going up and the forward PE. But there's a few things below the surface, and one of the ones that sometimes people send me is either the Citibank Surprise Index or the Bloomberg ECO US Surprise Index. And if you could see a chart on this, the Surprise Index was minus 0.4. Okay, what are you really looking at? Without getting into the numbers too much here, it measures, you think about earnings expectations, well, not earnings expectations, but you think about economic things where they say, unemployment's going to be 4% and it comes in at 5%. Well, that's a miss, but it's a negative miss because unemployment's higher. Or you say, well, the analyst said unemployment would come in at 4%, but it actually came at 3%. That's a positive surprise because it was, the analyst didn't get it right, but it was better news than expected. And so basically what you're seeing here is it seems like the economic data that's come out recently, the analyst or people, putting out targets and things like that, they have been wrong, but wrong to the negative side. And it's actually the lowest it's been, the most negative since around 2019. And to give you the sort of flip side of that, really the end of 2020, it was really, really positive, meaning it was coming in above the expectations. So analysts said, hey, things are going to be bad, and they're actually pretty good. So that's something, and I guess the question with this is, I go back and forth. It's like, are they getting it wrong, or are things really getting bad? In other words, are their forecasts bad, and it just so happens that it's missing to the negative side? So, this index, I don't know that you can read too much into it. Maybe there's a little bit of over bullishness, I guess, and some of the economic stuff. I do watch, and I'll put a link to the show notes, Econ PI. It's a website, and they put an analysis grid together. And basically, you have 4 different quadrants. You have the decline quad, the expansion quad, the recovery quad, and the contraction quad. And they look at all different things like non-financial profits for corporations, unemployment claims, temporary employment. I'm not going to read them all off, but the whole gambit. And recently, last few weeks, you've seen the median of coordinates, they call it. So the median of coordinates, what's that? It's sort of the median of all of those. And that's slipped down into the contraction quad. It doesn't mean that a recession is, hey, it's going to happen tomorrow. But typically, and they'll tell you, the economy is vulnerable to a recession when the median of coordinates has passed its peak and moves near the baseline. They also recently came out with a weighted median of coordinates. And again, I'll put a link in this to the show notes. But I think they put that out because the median of coordinates sort of went negative and we never had a recession. So then they started weighting some of them differently and they post them both. So I'll put that in there, but I always say, hey, do we want to scare people? Do we want to be overly bullish? It's just, I think things like this are things to watch. And it's one of the reasons why I believe that, being invested but being hedged makes a lot of sense for a lot of people, especially depending upon where you are in sort of your life cycle of investing. So here's a random one. And you all know that I watch random stuff sometimes. I'll talk about trucking in a second. Avocado prices are almost the highest they've ever been. Now, this is nominal. I don't think this is inflation adjusted. This is on a Bloomberg chart I was able to pull up. Somebody posted this on X, and I said, well, let me look it up on Bloomberg and take a look because they only had the most recent prices. And yeah, you've seen a really big spike. And this is, I guess, the Mexico City. I can't read the rest of it. It's an index, a price index for avocado. So I don't know if you're going to Chipotle, let us know if you're paying more for your guacamole because it seems like avocado prices are going up. What's not going up, though, is lumber. And taking a look at lumber as a future, it trades a futures contract. And so it's the nice thing about when you have a good or service, or I should say, a commodity that has futures pricing, you can see what people are doing with their dollars. And you're seeing what the market is really expecting there. So lumber is the lowest price going back to, well, it's actually, I should have pulled up a longer term chart. Bad on me for not doing that. But this goes back to December 1st of 23. This is from McClellan Financial. Saw this on Twitter as well. And yeah, lumber prices are coming down. Does that mean that there's going to see a slowdown in construction? I don't know, but it's something that take a look at. The Truck Tonnage Index versus the S&P 500. So, okay, I know I get made fun of for looking at shipping container prices and all that stuff. I won't talk about those on this episode. But the Truck Tonnage Index is another thing that is on the periphery. And when you see divergences, you just kind of say, well, what's going on there? And basically, the Truck Tonnage Index, it measures the gross tonnage of freight. So you think about stuff that's being carried around the U.S. and it's transported by motor carriers in the United States, so trucks. And I think there's a note here that 70% of all freight tonnage is via truck. So this is kind of interesting to watch. And you can't see the chart. I'll walk you through it. Basically, going back to 2002, 2003, the S&P and this index tend to operate very similarly. And what we have is this deviation where truck tonnage is going kind of sideways, but then the S&P index is going up. Now, the other take on this is what's kind of driving the S&P right now. It's not extra rolls of toilet paper. It's not like Campbell Soup is selling. I actually don't even know. I haven't looked at their numbers. But I'm going to assume Campbell Soup is not growing 100% year over year selling soup. It's a lot of technology and things like that. So not reading anything into it. I don't make predictions on this stuff, but it is something to take a look at. And I think it's something to keep an eye on. Is it anything? Maybe. Maybe it's nothing, though. And one of the reasons why I say, well, maybe it's nothing is the analysts are still raising estimates for the S&P 500 companies. And sure, I know this has a lot to do with NVIDIA and some of that stuff. But, earnings over the long term, the market or the S&P tends to follow earnings. In other words, if earnings are going up over the long run, the market usually follows the earnings or vice versa, or one goes before the other. The market is trying to make a forward estimate based upon what it knows, all the information that it knows. So if you look at this, you see that, the forward 1 year estimates, so that's all of the next 4 quarters, it basically says about $253.21. So, one of the things you can do is you can take that estimate, you can take that number and say, well, what's the forward PE, meaning the price divided by the estimate. And if the market, what do we close at the other day? I should have had this handy. Hang on a second. So 54.64 and some change, 54.64. And don't forget the 62 cents. If we kind of take a look at that and we divide it by the 253 and change, don't want to shortchange that there, it's about a 21.58 forward PE multiple. It's trading at 21.58 times. So what's interesting about where we are right now is, and I've heard different people talking about it. I think somebody on CNBC was making mention of this, that a lot of times earnings estimates come out high and then they wind up being revised sort of lower as more information comes out. Well, if I look at a chart of the forward estimates, it looks like analysts have been raising their estimates. And that's an interesting thing to look at. So, is the market overvalued? I don't know. I'll let you know in 6 months or 12 months. It's you don't sort of know until you know. That's why we hedge. That's why we're big proponents of hedging. But if I look here, it's about 21.5 times, 253.21. If you look at, let's say, in 1 year, what the next 4 quarters would be, it's about 285, and then sort of 2 years out, the forwards is 307.42. So, I like to look at this because I do believe that long term markets tend to follow earnings, and it's trading at 21.58 forward PE. The 12-month or the 4 quarter plus 1 year estimate, they're trading about 19.1 times, and the 1 year plus 2 years estimates out, if that even makes sense, how I said that, about 17.78. So 11% earnings growth over the next 4 quarters, and they have revenues growing as well. So, just keep an eye on this. Is the market overvalued? Is it undervalued? It's tough to know. And if you look at a stock like NVIDIA, its price has been going up, but because the earnings estimates have been going up, the forward PE has come down a little bit. So it's an interesting dichotomy there. Somebody asked me about Apple recently, and we look at Apple and we say, oh, what are their estimates going forward? Well, if you look sort of at just an annual estimates, and you say, what are the analysts saying for that? They have earnings per share growth of about 7.62 for fiscal year 2024. That, of course, ends in I shouldn't say, of course. Apple has a screwy kind of calendar where their fiscal year ends September 30th, and 2025 numbers are about plus 10.36. These are estimates, and estimates can change, but it is something to watch. And I got to be honest with you. I mean, a lot of people trying to figure out, is the market going up? Is it going down? Is it overvalued? Is it undervalued? We have the election coming up. And we'll do an election. We'll probably record an episode and we'll tuck it into another episode. We'll do our election thing as we get to the end of October, looking at the numbers, making some predictions that probably will wind up being wrong, but some will be right. And, we're just going to have to see. All right. I want to get to a listener question. And thank you all for sending questions in. We've been getting a lot of them lately. We love getting comments from listeners. You can send those to me at derek.moore@zegafinancial.com. That's DEREK.MOORE at Z as in zebra, E as in Eddie, G as in George, A as in Apple. Financial's up to you to get correct, to spell correctly. Okay. So the question that came up was from somebody who listens to the podcast. And I guess they either heard another podcast or might have been, for some reason, I think it was Jim O'Shaughnessy maybe, which would sound about right because he's, I can see him talking about this. And his question was, what is the volatility gap problem? And without having the full knowing where this came from, my answer on this, it's a good thing to bring up because I think it also plays into the fact that there is a case for hedging. And when we say hedging, we say either having something in the portfolio that goes up and makes money while the market is coming down, or controlling how much you can lose by limiting the amount of the investment, but still having exposure to the market. And what do I mean by my definition of the volatility gap? It's sort of the difference between an average return on the markets and the compounded annual growth rate. And a good way of looking at this is one of my favorite examples is you say, okay, let's say there's $1 million in an account. And year one, there's a loss of 50%. Okay, well, we know you go from $1 million down to 500,000, loss of 50%. Year two, there's a gain of 50%. And I know all of you in the audience are probably saying, oh, that doesn't mean you get back to even. No, that's right. Because a gain of 50% on 500,000 is only 50% of 500,000. So now you make an extra 250, but you're up to 725,000 and you're still down 25% or, 200 and, what are you down? Yeah. I mean, 25% there on your, did I do the math wrong there? Did I do the math wrong? I did the math wrong. It's 750%. I'm doing it in my head, by the way. So if we actually did edits on this show, so start with $1 million, you lose 50%, you come down to 500,000, and then you make 50%, and you get back up to 750,000. There you go. I shouldn't do these in my head. So you look at that. The reason I use that very simple example is number one is that's quite a bit of volatility. Down 50%, up 50%. That is a real roller coaster. But if I was to tell you that what the average return is, you average minus 50% and plus 50%. Your simple average is basically 0%. But you didn't get, your portfolio is still down 25%. You're not down zero. So the compounded annual growth rate is really representative of what an investor would sort of realize over time. And the compounded annual growth rate is actually about minus 13.4%. That's on an annualized basis. So thinking about that, the average annual return is 0%. The compounded annualized growth rate is minus 13.4%. And it's actually, it's like 10 numbers after the 13 point something, but I just rounded there. And why does that matter? Well, let's look at it. We know what we experienced, the minus 50%, the plus 50%. But let's say you have $1 million and that compounded annualized growth rate is minus 13.4%. Okay. If you lose, and again, I rounded that, but if you lose, minus 13 point, and a bunch of decimal places, you would say, well, you go from $1 million down to $866,025.40. And then you lose another 13.4-ish% on that. And you bring that down to 750,000. So your cumulative return is a minus 25%. Your annualized compounded growth rate is minus 13.4%. And the volatility gap is basically looking at the distance or the difference between what your average return is and what your compounded annualized growth rate is. And the larger those two numbers are apart, the more volatility one has had in their portfolio. And that's sort of, when you think about, it's one of the reasons why some people try and do this with, all weather portfolios, or you hear about the permanent portfolio. Harry Brown, I think he was the one who sort of came up with that, the permanent portfolio or the all weather and things like that. And it's the idea that it may not have the highest returns or highest average returns, but what it's trying to do is get a more smooth compounded annualized growth rate, and the less volatility that you have in a portfolio, the less that gap is. And so this really makes the case for hedging. And part of the idea is that, let's say instead of taking a 50% downturn, what if you only took 10% there, theoretically? And that's one of the benefits. And we know that with hedging, you do give up some of the upside because there's not necessarily a cost where you have to pay out, but there's, when you have hedges on, it's embedded in what you give up on the upside. So the idea of hedging is to reduce the volatility, maybe reduce that volatility gap, and also protect against those really, really bad downturns. Now, obviously, if you lose 50%, you need 100% to get back to break even. It's kind of how the math goes. But the compounded annualized growth rate is what one actually experiences. And that's assuming, by the way, that no money is coming in and no money is going out. When you have things that we manage money for people and we run reports, we use a lot of times what's called the time-weighted return. And the time-weighted return accounts for those cash flows coming in and coming out. And that's kind of important. But if no money's going in, no money's going out, it's a simple calculation there. If money's coming in, money coming out, it gets a little more involved. And of course, that is a nominal return. That's not a real return after inflation. But it's kind of a pet peeve of mine, is some people kind of go back and forth between real returns and nominal returns when it suits them or when it doesn't suit them. But yeah, also, obviously, if you have inflation, your after inflation return, inflation is going to be accounted in for that. All right. Other question I got was, Jay and I think it was last week, we took opposite sides. One of us said the market would touch 6,000 before the end of the year. I think I took that one. Jay said, no, that's not happening. And the question I got was, how are the probabilities really, when we hear about probabilities in the options market, how is that figured? Look, I'm not going to go through a step-by-step calculus formula. In fact, a lot of people might use Python or something like that to do these. But basically, I'll go over. I did look, right now, as of the close on Friday, the market, or 6,000, is about 9.8% out of the money, meaning it's 6,000 is above the market by 9.8%. And I looked at so what's the down 9.8% equidistance? And that would be 49.30. And I looked at the probabilities of expiring there. So there's two different probabilities. There's one of what's the probability of the market, and I looked at the December 31st expiration, so right at the end of the year. And there's two different probabilities. One is what's the probability of a market expiring at least a penny in the money, meaning 6,000.01 on, let's say, a call in the money. Or on the puts, what is that? 49.29.99, meaning, a penny below the 49.30 strike. That's one probability. And that means that, the other probability is what's the probability of touching those levels? And the probability of touching a level versus closing in the money on one of those is usually, it's higher, because you could have a market anytime. Look, market could 2 months from now, a month from now, it could be at one of these prices, but it winds up reversing back or doing something different, and it never expires there in the money. And so I looked, and the 6,000 contract for December 31st, there's about a 17% probability as of the close Friday that it expires at least 1 penny. So 6,000.01 would be a penny in the money above there. And the probability of touching, though, is actually higher. It's about 34%. When I look at the put side, and we'll save this for another day, why these are a little different, but it's about 19.8% is the probability of expiring a penny in the money for 49.30 puts, same equidistance, 9.8% out of the money, and about 39% probability of touching. So how are those done? Well, when we look at the probabilities, it's basically you're looking at what is the current underlying price. So I think we said the market closed about 54.60, the S&P 500. I'd have to go back to another screen to look. We're looking at the strike price. So the strike price is, like the 6,000. We calculate the time. So there's 192 days to expiration on the December 31st options. So it's basically 192 divided by 365, and you get sort of a decimal. You look at what the implied volatility is, if you have it, on the options chain, and you look at the risk-free rate. And from there, it's sort of it's a longer formula with a lot of different equations and stuff. But basically, you're taking the options market data and using those inputs and saying, okay, based upon those, it's really just using the data. And the options market is an indication of where money is flowing or the opinions about the market. A good example of this is if you look at NVIDIA's volatility versus Campbell Soup, the expectation is NVIDIA is going to have a wider range of outcomes than Campbell Soup. I don't know why I'm not picking on Campbell Soup, by the way. I haven't looked at their options market, but I pretty much know that NVIDIA is going to have a higher volatility than Campbell Soup. Okay. So you're just looking at those numbers, and based upon the numbers, it's a calculation. And probabilities are not certainties. They're going to change. They'll change as time sort of moves, as volatility moves, as the underlying stock price moves, and to a lesser extent, the risk-free rate. But if you look and you say it's price and time and volatility really are the main drivers. And when you look at a market and you say, okay, I have 192 days left. By the way, if I was to do that same calculation on an option that had 2 weeks left to expiration, the probabilities would be much, much, much lower, because now you only have 2 weeks versus certainly, 192. Yeah, that's a little more than 6 months, right? So that's kind of the way that I look at that. I'll put you to sleep if I go through step by step. You can Google it, or maybe at some point if I find a resource, I'll put it on there. But it's just a calculation, and I went through and I did it, and I got pretty close to what Bloomberg or Thinkorswim from Schwab was saying as well. So that's the probabilities. And another way to look at this is when you have an implied volatility, you can understand what an expected one standard deviation move, meaning 68% of the time price will be between here and here. You can't see my hands, but just trust me, I've got my hands kind of left and right. And it's just saying, hey, that's 68% of the time, one standard deviation, markets will be between here and here. So All right, we're going to call it there. I'm trying to think, anything else we need to clean up this week? A couple ideas for maybe some recommendations. I did watch The Hitman, and it's I don't know. I watched back to back with it was Anyone But You. I think I mentioned that, which I thought was entertaining. The Hitman I thought was entertaining on Netflix. I would say, yeah, is it what did Goldman used to call it, a conviction list? I would say it's a buy. I don't know if it's a strong buy. I don't know if I'll watch it again, but I thought it was entertaining. So, and it's just a movie. I tend to like movies because you're not sucked into watching 3 seasons of episodes. I did watch the Bratz documentary on Hulu about kind of the Brat Pack and young 80s actors, Emilio Estevez, Andrew McCarthy, Rob Lowe and company. I don't know. I'm going to put a hold recommendation on that. If you have, if the weather's bad and you've watched everything else, maybe take a look. I don't know. It just was a little bit repetitive, but it was kind of neat to see all those people, or at least the people who participated in it again, and to hear a little about, there's some insight there, but I don't know. I wasn't crazy about it. That's it. That's so the Hitman. And then if you are a hockey fan, and even if you're not a hockey fan, you should be watching Game 7 on Monday. So it's you think about probabilities. The Florida Panthers are a hockey team in Florida, Edmonton Oilers, hockey team in Edmonton. And Edmonton has won Stanley Cups before. Wayne Gretzky played for them. They have Connor McDavid now. The Florida Panthers are up 3-0 in the series. You have to win 4 out of 7 to win the Stanley Cup. Get the final, the win the championship. And I'd have to look, but the probability of a team coming back from a 3-0 deficit. So think about this. The Oilers will have to win 4 straight to come back and win the Stanley Cup. And they've won 3 straight. And it's never happened in the NBA. I think in the playoffs, I should have pulled it up. It's something like out of 165 times or 175 times, teams have never come back from a 3-0 deficit in a series. In baseball, it happened once. I don't even want to talk about it. You can Google which teams were involved. I am a Yankee fan. That should tell you enough. Happened once ever where a team came back from a 3-0 deficit. I guess also I don't know if when series became 7 games. Sorry. In football, you don't have 7-game series. In hockey, it's happened 4 times ever. I think the last time it happened in the Stanley Cup Finals was 1942. And so Monday, Game 7, winner take all, and we'll see what happens there. But it's Game 7s are always really good in sports, so that's a recommendation as well. But you get it. We're just talking about probabilities. Like, what's the probability a team is up 3-0 in a series and they're going to lose 4 straight? Could happen. All right, everyone. We'll call it there. Send emails, derek.moore@zegafinancial.com. I will try and take more and more listener questions. I appreciate the 2 questions we highlighted today, and we'll do more of that in the future. See you, everyone.